Receivables and inventory are among the most material current assets reported in financial statements and therefore receive significant audit attention due to their susceptibility to material misstatement arising from fraud, error, valuation uncertainty, and management manipulation. International standards on auditing require auditors to obtain sufficient appropriate audit evidence regarding the assertions of existence, completeness, valuation, rights and obligations, accuracy, cutoff, and presentation associated with these balances. Because both receivables and inventory directly affect reported profit through revenue recognition and cost of sales, weaknesses in these areas may have a pervasive impact on the financial statements. Consequently, auditors employ a combination of substantive procedures, analytical procedures, external confirmations, physical inspection, and documentation review to obtain reasonable assurance that these balances are fairly stated in accordance with the applicable financial reporting framework. The principal audit objectives for trade receivables are to verify that recorded balances genuinely exist, belong to the entity, are accurately valued, completely recorded, and appropriately presented within the financial statements. One of the most persuasive forms of evidence is the direct confirmation of accounts receivable, whereby the auditor requests customers to confirm balances outstanding at the reporting date. Positive confirmations require customers to respond whether they agree or disagree with the balance stated and are generally used for material or high-risk accounts, while negative confirmations request responses only where disagreement exists and are appropriate only when control risk is low and populations are large and homogeneous. External confirmations provide highly reliable evidence because they originate from independent third parties and directly support the existence and accuracy assertions relating to receivables. Where confirmation responses are not received or where confirmations are inappropriate, auditors obtain alternative evidence through substantive procedures. These include examination of subsequent cash receipts after the reporting date, inspection of sales invoices, customer orders, delivery notes, contracts, correspondence, and remittance advices supporting outstanding balances. Review of aged receivables listings assists auditors in identifying overdue accounts requiring impairment provisions, while comparison of allowance calculations with historical collection experience and economic condition supports valuation assertions. Reconciliation of subsidiary receivable ledgers with the general ledger further confirms completeness and accuracy. These procedures collectively provide evidence regarding existence, valuation, rights, and completeness where direct confirmation evidence is unavailable or insufficient. Additional procedures relating to prepayments and other current assets focus primarily on verifying existence, ownership, completeness, and appropriate allocation between accounting periods. Auditors inspect supporting invoices, contracts, insurance agreements, lease documents, and payment records to confirm that prepayments relate to future accounting periods and represent genuine economic benefits. They also review subsequent expense recognition to ensure appropriate allocation across reporting periods. For other current assets such as deposits or short-term advances, auditors inspect legal agreements, bank documentation, and supporting correspondence while confirming recoverability where necessary. Such procedures ensure that current assets are neither overstated nor improperly classified within the statement of financial position. The audit of receivables is closely linked to verifying the completeness and occurrence of revenue, one of the most significant fraud risk areas identified under ISA 240. Occurrence testing ensures that recorded sales transactions genuinely occurred and relate to legitimate customers through inspection of customer orders, dispatch documentation, sales invoices, and proof of delivery. Completeness testing seeks assurance that all valid sales transactions have been recorded by tracing dispatch notes or shipping documentation to accounting records. Analytical procedures comparing revenue trends, gross profit margins, and receivable turnover with prior years or industry benchmarks may identify unusual relationships suggesting premature revenue recognition or omitted sales. Particular attention should be given to year-end transactions and related party sales where management incentives to manipulate reported performance may exist. Inventory represents another significant audit area because valuation and physical existence directly influence reported profitability and asset values. The principal audit objectives include verifying existence, completeness, ownership, valuation, and correct presentation of inventory balances. Inventory counting procedures differ depending on whether the entity operates a periodic year-end count system or a perpetual inventory system supported by continuous inventory records. Under periodic systems, comprehensive physical counts occur at year-end, whereas perpetual systems maintain continuous inventory records supplemented by cyclical count programs throughout the year. Auditors evaluate the reliability of inventory systems and determine appropriate procedures based upon the effectiveness of internal controls and inventory management practices. Auditor attendance at inventory counting represents an important source of audit evidence where inventory is material. Attendance enables auditors to observe management's counting procedures, evaluate count instructions, inspect inventory condition, perform independent test counts, identify obsolete or damaged goods, and assess whether inventory controls operate effectively during the count process. Test counts performed by auditors are subsequently reconciled to final inventory records to verify count accuracy and completeness. Observation also enables auditors to evaluate whether inventory movements during counting are appropriately controlled and documented. Although attendance does not guarantee inventory existence, it provides persuasive evidence supporting management's inventory records and enhances the reliability of subsequent valuation procedures. Cutoff testing is essential for ensuring that inventory purchases and sales are recorded in the correct accounting period. Auditors examine goods received notes, dispatch documents, purchase invoices, and sales invoices immediately before and after the reporting date to confirm that transactions have been recognized in the appropriate financial period. Incorrect cutoff may materially distort inventory balances, purchases, cost of sales, and revenue recognition. Particular attention is given to goods in transit, consignment inventory, and returns occurring near year-end, where timing differences frequently arise and increase the risk of material misstatement. Where inventory is held by third parties, such as warehouses, logistics providers, or manufacturers, auditors may obtain direct confirmation from the custodians regarding quantities held on behalf of the entity. Independent confirmations provide persuasive evidence regarding inventory existence and ownership where physical attendance is impractical. Additional evidence may include warehouse receipts, storage agreements, shipping documentation, and inspection reports. Auditors should also evaluate the competence and independence of third-party custodians where reliance is placed upon their records. Inventory valuation requires auditors to verify that inventory is measured at the lower of cost and net realizable value in accordance with applicable accounting standards. Procedures include reviewing costing methods, recalculating weighted average or FIFO costs, inspecting supplier invoices, evaluating production overhead allocation, examining inventory aging reports, identifying obsolete or slow-moving items, and reviewing post-year-end selling prices to assess net realizable value. Additional evidence includes analytical procedures comparing gross profit margins and inventory turnover with prior years, together with physical inspection to identify damaged or obsolete goods. Through these comprehensive audit procedures, auditors obtain sufficient appropriate evidence supporting the existence, completeness, ownership, valuation, and presentation of receivables and inventory, thereby enhancing confidence in the reliability of financial reporting and the integrity of the audit opinion.